Everyone's buying tech. Markets are hot. Optimism is everywhere. But if everyone's making money, why is Warren Buffett cashing out billions? He rarely sells. But when he does, he's not guessing. And this quarter, he made his biggest move in years, over $4 billion in stocks sold. At first glance, it looks random. A few banks, some tech, a media company. But if you look closer, there's a pattern. He's not betting on a crash. He's betting on what survives after one. And the clues are buried in the data. In this video, I'm breaking down exactly what Buffett sold, what he's buying, and most importantly, why. If you want to understand how one of the sharpest investors on the planet is reading the market right now, this is the video you need to see. Before we dive into what Buffett sold and bought, we need to zoom out. Because this quarter's $435 billion shuffle, it's not a one-off. It's part of a larger rhythm that Buffett has followed for over 6 decades. Buffett's strategy isn't just buy low, sell high. It's to buy great businesses at fair prices and sell only when the fundamentals shift or the price gets ahead of value. Right now, Berkshire Hathaway is sitting on over $340 billion in cash. When the market overheats, Buffett trims. When it corrects, he pounces. This is where Buffett shines. While most investors are chasing momentum or headlines, he's looking at ROIC, price to cash flow, and the long-term durability of a business. His philosophy is grounded in discipline, not predictions. He doesn't need to guess the next Fed move or inflation number. He reacts to valuations. That's it. And the data backs him up. Take Apple. Between 2022 and 2024, Buffett sold billions in Apple shares despite the stock still climbing. Why? Because its valuation ballooned and it became too large a part of his portfolio. That wasn't fear, it was risk management. This same lens applies to Q1 2025. Buffett didn't dump stocks out of fear of collapse. He likely recognized that the risk-reward no longer justified the capital. That's Buffett's style. Allocate every dollar where it can earn the highest return per unit of risk. And when he doesn't find compelling bets, he does the most unpopular thing in investing. He waits. Holding cash isn't flashy, but for Buffett, it's a strategy. It gives him the power to move big when others can't. So, if you're wondering why Buffett just sold billions, it's because he's clearing the table for his next big move. Let's break down exactly what Warren Buffett sold in Q1 2025, and more importantly, why. This isn't just a list of tickers. It's a strategic repositioning of over $4.35 billion, signaling what Buffett no longer sees as value in today's market. The biggest complete exit? Citigroup. Berkshire Hathaway sold all 14.6 million shares, worth roughly $1.1 billion. This wasn't unexpected. Citi's return on equity has hovered near 6%, far below peers like JP Morgan. Operationally, it's struggled with inefficiencies, and regulators have been pushing hard for structural changes that squeeze margins. Buffett originally stepped in during a dip in 2022, betting on a turnaround, but that rebound never came. With the efficiency ratio stuck above 60%, meaning Citi spends over 60 cents to earn every dollar of revenue, it's spending too much to earn too little. That's not the kind of long-term compounder Buffett bets on. Then there's new holdings. Buffett exited this Brazilian digital bank entirely, 40 million shares, worth around $482 million. The company was once hyped as the future of fintech in Latin America, backed by explosive user growth. But reality hit hard. Operating income stalled, and losses continued mounting amid high inflation and unstable interest rates in key markets like Brazil and Mexico. At the time of Buffett's exit, New Holdings was trading at a forward price-to-earnings (PE) ratio of approximately 24.3x, reflecting a premium valuation compared to traditional banks. While this is lower than the previously reported 70x, it still indicates a significant valuation for a fintech company operating in emerging markets. He likely entered this position early as a bet on financial inclusion, but when fundamentals didn't follow through, he cut the cord. Even more eye-catching was the massive trim to Bank of America, a longtime Buffett favorite. He sold 48.6 million shares, cashing out around $2.1 billion. While he still holds a large position, this trim raised eyebrows. The likely reason? Macro headwinds. Banks like Buffett are now struggling with tightening net interest margins as rate hikes fade. Plus, there's concern around consumer loan quality and commercial real estate exposure. Even though the bank remains profitable, Buffett can see limited upside in the next few years. So, he's locking in gains and moving capital elsewhere. Another smart trim came from a less obvious place: Liberty Media Formula One. Buffett sold roughly 3.3 million shares, equal to about $317 million. Formula One's surge in popularity, from Netflix to global races, drove the stock to trade near 40 times earnings. But growth has begun plateauing, and monetization per viewer isn't scaling fast enough. Liberty's debt load is also hefty, making it sensitive to economic slowdowns. It's the classic Buffett move: great brand, but the numbers don't justify the price. He cashed in his gains. The same logic seems to apply to T-Mobile US, where Berkshire trimmed around 466,000 shares, worth approximately $113 million. T-Mobile still leads in US telecom, but the growth phase is maturing. Net subscriber additions have slowed, and the stock trades at a lofty PE ratio. Buffett isn't known for holding on to richly valued slow-growth plays. This looks like a mild portfolio adjustment, lower exposure to a sector with limited upside. Lastly, there's Capital One. Buffett offloaded about 300,000 shares, totaling $56.7 million. While the bank's card business generates solid income, consumer credit risk is rising. Charge-offs and delinquency rates have ticked higher amid record-high household debt. This could be Buffett playing defense. He's always cautious about economic cycles. When the average household is stretched, credit exposure becomes dangerous. So, in total, Buffett sold off or trimmed more than $4.35 billion in Q1 2025. The theme is clear. He's reducing exposure to banks, financials, and richly valued media and telecom. Not because these businesses are doomed, but because the price-to-value equation no longer works. Buffett doesn't hold for the sake of holding. When the story changes or the valuation runs too far ahead, he reallocates and cashes in his gains. And if history tells us anything, it's that when Buffett sells big, he's preparing to buy better. So the next question is, what did he put that capital into? While the headlines focused on Buffett's $4 billion in sales, very few people noticed what he quietly added to Berkshire Hathaway's portfolio in Q1 2025. They followed the same playbook he's always used: buy quality, buy cash flow, buy when others aren't looking. Let's start with the biggest ad: Constellation Brands. Berkshire bought over 6.3 million shares, investing around $1.17 billion. Constellation owns powerhouse alcohol brands like Corona, Modelo, and Robert Mondavi. In a slowing economy, people may cut luxury, but they don't stop buying beer and wine. Constellation Brands boasts a strong operating margin of 34% in its beer business, reflecting efficient operations and a focus on high-margin products. Plus, it trades at a modest PE of 14, well below peers. Buffett's move here is textbook defensive investing: stable cash flows, strong brand moat, and low volatility. Then there's Occidental Petroleum. This is Buffett's big energy bet, and it's only getting bigger. He added 763,000 shares, pushing Berkshire's total stake to nearly 28% of the company. The idea is energy security, strong free cash flow, and inflation resilience. Occidental generated over $4 billion in free cash flow last year and continues paying down debt aggressively. Buffett loves companies that can self-fund growth, and Occidental fits the bill. The wildcard buy this quarter was SiriusXM. Buffett picked up around 2.3 million shares, valued at $58.8 million. This one raised eyebrows. Sirius is down more than 60% from its highs, and many see it as outdated media. But under the surface, it generates over $1 billion in free cash flow, with high-margin subscription revenue. It's a contrarian play, one that aligns with Buffett's history of buying unloved cash machines. Another ad that caught attention was Domino's Pizza. Berkshire bought 238,000 shares, totaling around $113 million. Domino's isn't just a fast food chain, it's a logistics powerhouse. Over 40% of orders now come through digital platforms, and its international growth remains strong. The stock trades at a PE of 24.36, with predictable earnings and strong brand loyalty. In volatile times, Buffett gravitates towards simple, scalable models, and pizza fits that mold. Pool Corp is a fascinating new holding for a couple of quarters now. Berkshire added 865,000 shares, investing about $260 million. Pool is the world's largest distributor of pool equipment and outdoor living products. It operates in a niche with minimal competition, high repeat business, and strong pricing power. Earnings per share have grown consistently for a decade, yet the company remains underfollowed. Lastly, VeriSign. This wasn't a new position, but Buffett added another 18,000 shares, worth roughly $5 million. VeriSign runs the .com and .net domain infrastructure, essentially the plumbing of the internet. Its business is so predictable that it has close to 70% operating margin and generates over $800 million in free cash flow annually. This small addition shows Buffett doubling down on stable, cash-generative digital infrastructure. What do all these picks have in common? Cash flow, predictability, valuation. None of these companies are momentum darlings. They're not trending on FinTwit, but they all operate with consistent margins, generate cash, and trade at fair prices. Buffett is buying foreseeable returns, and that gives us an important lens into how he's viewing the current market. So what does it all mean? Let's piece all of this together and unpack what it signals for the broader economy and smart retail investors. When you line up Warren Buffett's Q1 2025 portfolio moves side by side, a pattern emerges, and it's a classic Buffett message, delivered not through a press conference, but through capital allocation. Buffett isn't panicking, he's preparing. Selling off Citigroup, New Holdings, and Bank of America wasn't about fear. It was about valuation and risk. These companies either failed to deliver the returns Buffett expected or became overpriced relative to their growth potential. Meanwhile, look at what he's buying. Occidental, Constellation Brands, Pool Corp, and SiriusXM. These aren't headline-making companies. They're boring, but Buffett doesn't want exciting. He wants cash flow and control. Each of these companies has predictable earnings, better valuations, PE below 20 in most cases, market leadership or monopoly-like niches, minimal exposure to high-interest debt. That's not a coincidence. Buffett is repositioning away from overexposed cyclical sectors and into steady, cash-rich businesses that can weather an economic cooldown. Why now? Because the market is sending mixed signals. Inflation is stabilizing, but growth is slowing. Interest rates may fall, but consumer debt is climbing. Buffett seems to be signaling that things might look fine, but they're not priced for risk anymore. His trimming of financials and telecoms, industries heavily reliant on growth and stable interest margins, shows he's not confident in their short-term returns. His buys reflect a tilt toward durability over drama. He's not chasing AI, crypto, or tech unicorns. He's ignoring the hype and doubling down on fundamental investing, just like he always has. Right now, Buffett's windshield is pointed at boring, predictable, undervalued cash machines. That tells you a lot about his outlook, and maybe a bit about what retail investors should be doing too. Want to know what other super investors like Bill Ackman, Michael Burry, Howard Marks, and Monish Pabrai are buying in this uncertain environment? Click the video on screen to find out.